Income statement tracks companies' revenues and expenses during a particular period like quarter or year. It shows how company revenues are transformed into net profit. In my view, the income statement is best understood by looking at the actual statement. In this session, I will explain how income statement look for a listed company, and how to analyze income statement using notes. Here, I will show you income statement of HUL from March 2021 annual report. The first line on income statement is always the revenue from operation followed by other income. The next line item is expenses. There are several expenses listed under this line item. Exceptional items is just another category of expenses that show up on income statement. The next line is profit before tax. It is calculated as total income minus expenses. Just like individual taxpayer, company must pay taxes to the government. The tax is deducted as certain percentage of profit before tax income. The next line is profit for the year or net profit. The net profit is calculated as profit before tax minus tax. The next line is earnings per share. Net profit is divided by number of outstanding shares to get the earnings per share. Typically, you will notice these line items on every income statement. For an obvious reason, line items in income statement can change slightly depending on sector and nature of business. However, the basic concept will remain same. I hope you noticed column with heading note. The main purpose of notes to the financial statement is to further clarify the breakup of each line item in annual report. To provide you more insight, HUL has different products like home care, beauty, personal care, food and so on. If you want to know how much revenue is produced by each product line, you should go to note 24 to understand the revenue breakup. This is very important, to seek deep insight into company's revenue and expense. Let's go over few line items deeper, to develop good understanding of income statement. Income is reported under two separate lines. First, revenue from operations. Second, other income. In annual report note 24 and 25 provides the income breakup. Revenue from operation is recorded when company sell product or provide services. Products are material things like television, refrigerator, car, shoes, food items, software product and so on. The services include banking, travel, entertainment, hotel and so on. In other words, this is the revenue generated by company from core business activities. Let's dig more into note 24. It provides several details, depending on nature of business like what is the breakup of revenue by product, segment or line of business. For multinational companies, you might be interested in knowing revenues by country or region. How much revenue company is generating through sale of product and services distinctly. For HUL, revenue from operation is broken down into different business segments. You can notice revenue from different product lines like home care, beauty and personal care, foods and so on. Segment reporting provides better understanding of how different lines of business are performing. How is the trend in revenue, increasing or declining? This is very important information to understand how your business is doing. Note 25 provide details of other income. Other income is generated through activities apart from company's core business. It includes income generated by various sources. Just like individual, company has cash which is under current or savings account or fixed deposit. Interest income is earned on savings account and fixed deposit. It also includes dividend income due to investment into other companies or subsidiaries. Other non-operating income. It is the income generated through renting a company building or equipment, sale of property, plant or equipment, insurance claim, royalty and so on. Now, it's time to understand expenses. Company generally classify expenses into few line items. Depending upon the nature of business, similar company will have similar expenses. Typically for product manufacturing company, you will see these expense line items. Now, it's time to go into details of each line item. Let's start with cost of materials consumed. It is the expense associated with raw material required for producing finished goods and cost of packing materials. Next, purchases of stock in trade. It is the expense associated with purchase of finished goods. For example, automobile company purchases steel and tires for making car. Please note, cost of materials consumed, and purchases of stock in trade is the expense directly associated with producing products or providing services. In general, this expense increases with increase in revenue. Next line item is changes in inventories of finished goods, work in progress and stock in trade. This can be little bit tricky concept to understand. When company makes a product, there are associated expenses. On income statement, these expenses will show up only when product is sold. Product can be sold in the current year or over next several years. This specific line item refers to the costs of manufacturing incurred by the company in the past. However, the goods manufactured in the past were sold in the current financial year. This is calculated by noting inventory at the start and end of the year. The next line item on the expense side is employee benefits expenses. It includes expense incurred in terms of employee salaries, wages, bonus, share-based compensation, contribution to Provident Fund, staff welfare expenses and so on. Let's move on to the next line item. Finance costs. When company chooses to borrow money to run its daily operation and expansion, it must pay interest. Finance cost refers to the interest and other costs incurred on debt. This is an important item to review under expenses. I generally prefer no or little debt. The next line item is depreciation and amortization. I will explain in next slide. The last line item on the expense side is other expenses. All expenses which does not fall under the previously discussed line items are booked under other expenses. Other expenses include several items like advertising and promotion, selling, administrative, rent, insurance, travel and so on. Generally, you will see a long list of expenses under other expenses. It deserves an attention especially when a huge amount is classified under other expenses. You can review note to the financial statement to further clarify breakup of each line item in annual report. Let's review note 31 to understand depreciation and amortization expenses. You can review depreciation and amortization expenses under note 31 to the financial section. Depreciation and amortization is a non-cash expense on income statement. This sounds mysterious. Let's take an example to understand. What does it mean? Company spend money on buying machines and equipment that have life of several years. Let's assume company ABC has earning capability of 20 crore each year. Company bought new machine for 10 crore that will have an expected life of 10 years. Company will pay upfront cash to buy the machine. If you add 10 crores under the expense, company income statement will be skewed for that year and will not reflect the true earning capability. Remember, important point to note is that the new machine has useful life of 10 years. Hence, from accounting perspective, the expense will be recorded as 1 crore every year for next 10 years on income statement. This means such cost is spread across useful life of the asset. Amortization is a similar concept for intangible assets like goodwill, patents and copyrights. You might wonder, this means company ABC had a major expense of 10 crore and it's not truly reflecting into income statement. This is addressed into cash flow statement which is prepared based on cash entering and leaving the company. The last line item on the expense side is exceptional items. This is also sometimes referred as extraordinary items. This expense item is generally both unusual and infrequent. This can be either income or expenses for the company. Expenses are generally associated with company restructuring, integration efforts for acquisition of new company and so on. If this expense keeps appearing regularly on income statement, it can be a red flag. One should investigate such item in detail. Till now, I covered income and expense lines. Now it's time to calculate the profit. When you take the total income and subtract total expenses, you get profit before tax. Company must pay taxes on this income. You arrive at the net profit after deducting all the applicable tax expenses from the profit before tax. The last line on the income statement is earnings per share, commonly known as EPS. It is calculated as net profit divided by number of shares. I hope by this time, you are feeling much better. You should be able to understand the income statement. Let's revisit all the line items again. It starts with income. Income has two distinct line items, revenue from operation and the other income. The next line item is expenses. It is the expenses associated with manufacturing and selling products or services. Next line item is profit before tax. It is calculated as total income minus total expenses. Next line item is net profit or profit for the year. You arrive at the net profit after deducting all the applicable tax from profit before tax. The last line on the income statement is earnings per share. It is calculated as net profit divided by shares outstanding. Please remember almost all the line items on income statement will have an associated note. You can review notes in annual report to seek greater clarity and break of each line item. Thank you.